Okay, let me see. I've got the recording going. I've got the PowerPoints set up. It looks like everyone is here. So let's go ahead and get started with talking about budgeting. So first, I want to have a little bit of an introduction about me as well as this whole webinar. I'm Chad Lively. I'm the lead financial planner and owner of Lively Financial. I originally created this presentation because I've been helping a lot of clients lately that have come to me, that we've worked on building goals and they have great ideas, but they don't have a budget in place to accomplish them. So I thought this would be a great opportunity to sort of go through, recognize that our financial well-being plays a massive role in our lives. Money or the lack thereof will significantly impact your stress levels, your future, and your overall happiness. And that's really what today's presentation is all about. We're going to dive into the importance of budgeting and managing cash flow, two fundamental pillars of your financial success. The goal of this presentation is to go through the budgeting process, list some things that you should be including in your budget, and offer insight into how you can accomplish your financial goals. Budgeting really is the first step in developing success financially. It is also going to be the first place you look when things are going wrong or need to be updated. So in this webinar, we're going to go through the PowerPoint by first discussing a little bit about setting financial goals to budget toward. Then we're going to discuss some budgeting strategies, create an outline of a budget step by step, cover some basic information about getting into investing and opening accounts. And finally, we'll finish the webinar with additional information and Q&A at the end. I highly recommend that as we go through this, you have something to take notes on. Sitting down and actually creating a budget line by line is oftentimes the hardest part of sticking with one. So as we go through this whole webinar, you can be taking the hour to make yours on a sheet of paper or Excel sheet, and I can promise you, it will be worth it. It'll definitely enhance the webinar. You'll have something to take away with it. So having a well-made budget will reduce your stress, help you accomplish your goals, and it will give you accurate control over your finances. Gaining all those benefits is the whole point of this webinar. Before we get into any information, for compliance, I have to give a disclaimer that all of this is based off of my industry experience in the financial industry, working with my clients, and all this information is for educational purposes. Everyone's situation is inevitably going to be different, and there's no one size fits all when it comes to financial advice. So think about your specific situation before putting any advice into action, and when in doubt, get a third party. I would be happy to help anyone on this call, so don't hesitate to reach out to me with questions or anything else I can help you with. Now, with that out of the way, we can finally get into things, starting with financial health, namely understanding the concept of our financial health from a holistic perspective. As I alluded to in the introduction, budgeting and your financial situation isn't just about the money in your bank account. It's about your financial habits, your ability to manage debt, and your strategy for the future. While having a higher income certainly helps, most of your financial habits come from factors beyond just income. And the first step to understanding your financial health is tracking income and expenses. This is going to be a big part of future slides, but I wanted to go ahead and have a slide a little bit earlier on because if you currently have some sort of system of tracking your income and expenses, or you have bank account statements, I recommend you go ahead and pull those up before we actually get into the steps of doing it. That way you have information to draw from whenever we actually start the budgeting process. So if you aren't currently using some method of tracking your income and expenses, you're missing out on having a lot of control over your financial health. It is what is going to allow you to assess your financial habits, identify any areas of improvement, and that's really what lets you make informed financial decisions. You fundamentally cannot make completely sound financial decisions without understanding your entire financial situation. I know it might seem like a lot of work, and at first it definitely can be, but it will get easier. If you aren't tracking your money, you will struggle to build and follow a budget. It requires some discipline, but it is well worth it, and you will be in a better position long term. So like I said, if you have any sort of information that will shed some light on your income and expenses, go ahead, and I would recommend pulling those up now, and we'll, in about a couple of slides, actually start going through the steps of making a budget. First, though, I find that something that really helps with that discipline aspect I was just talking about is having well-defined financial goals. So before we start the budget, I think it's important to lay some out, understand what you're saving toward. This will go a long way in making it feel more satisfying to track your spending and stick with your budget. Every time you have to deprive yourself of something to stick with your budget or add more to savings, I recommend you establish clear and attainable financial goals. It will make it much more rewarding and a lot easier to, give up some satisfaction in the short term, knowing that you have the long-term satisfaction of accomplishing your goals. So I would start with laying out some short-term goals, like building an emergency fund or planning for a vacation. Then I'd have some medium-term, like building a down payment on a car or a home, or a long-term goal, like saving for retirement. That's one that I figure most people will probably have on here. So these goals are going to help guide how we construct our budget, and they're also going to be a huge motivating force for sticking to it. So I recommend right at the start of the paper or the Excel sheet, list some goals that you have. And I'm kind of putting you on the spot. So I don't expect you to have it now, but come back here once we've sort of finished making our budget and try to attach a dollar amount to these goals. Try to figure out how much you need for retirement. Try to figure out how much you might need for a down payment for a car or a home, or how much you might need for an emergency fund. Right now, we're just sort of listing the goals, but try to come back to it later and try to figure out just how much money you need to accomplish these goals. Now, the types of budgets. With some goals laid out, we can actually get into making our budget. Just like your financial goals and just like an exercise plan, budgeting isn't one size fits all. It's a personalized plan, and there are different types of budgets. What works best is going to be the plan that will accomplish your goals and that you're going to be able to stick with. The two budgeting methods that I recommend are zero-based budgeting. That's one that most people have probably heard of, or the 50-30-20 budgeting rule. Zero-based budgeting is going through and assigning every dollar a specific purpose, tracking how much your income and expenses are and determining what every dollar is going toward. This means getting as granular as saying, I'll spend $80 on gas this month, $15 on Netflix, $150 on eating out, $300 on groceries. Really getting into the specifics of where your income is going to go. Some people will physically do this with paper envelopes to literally set aside the money for its intended purpose. That's pretty old school and something that Dave Ramsey would preach about all the time. Now, modern day, there are apps and things that can kind of accomplish the same thing, but zero-based budgeting is still very strict. This whole gives every dollar a name approach can be tough for some people who aren't maybe as organized, or they have very volatile incomes. I have a lot of clients that work in sales, for example, and just because of that, they get paid on a commission basis. So their income fluctuates a great deal. It can be pretty difficult for them to have a budget that is as strict as a zero-based budgeting style is. But I will say the budgeting style works great if you can manage that level of organization and you want a very clear-cut budget. An alternative to zero-based budgeting is the 50-30-20 rule of budgeting. It's sort of on the other end of the spectrum. It's more flexible. It's for people who may not be as organized or may have a lot of fluctuation in income and expenses. For the 50-30-20 rule, you'll split your income into three categories: needs, wants, and savings, with 50% going towards needs, 30% going towards wants, and 20% going towards savings. You'll still need to track your income and expenses, When it comes to budgeting, that's pretty unavoidable, but this style of budgeting is much more flexible than a traditional one where you plan out specifically where every single dollar will go. You're also going to have the option to sort of play around with the numbers. Maybe you want to live a leaner lifestyle and save more, or your needs maybe take up more of your income. You can decide you'd rather have 60% of your income go towards needs, 15% go towards 15% go towards wants, and 25% go towards savings. Figuring out the best split will depend on your financial situation, how much money it requires to achieve your goals, and how much time you have to save for them. For a lot of people, a combination of the two I find to be a really good place to start for them. For example, maybe you want to sort of zero-based budgeting, meticulously plan out the 50% of your income that's going to go towards needs and the 20% of your income that's going to go towards savings. And then you just say, okay, that leaves $400 to go towards my wants per month. That's a completely valid budget. Between these two approaches, or a combination of the two, we should be able to tailor our budget to fit our unique financial situation. So we can finally get into it with step one. It's time to get practical. Crafting the budget is the first step is going to be accurately calculating your income. This means considering every source from your regular salary to occasional bonuses, and you want to use a large sample size. Don't just go off how much money you made last week or last month. If you've been at this job for 6 months or a year, use the last 6 months or a year to calculate your income. We want this to be as accurate as possible. If you have multiple streams of income, such as multiple jobs, specify where your income is coming from, know when you get paid, put that down right next to your income source. From here, I recommend you break your pay down into the time frame you want to budget for. Do you want to have a weekly budget or a monthly budget? Calculate your income, figure out what your income is on average per week or per month. And all this information is really going to be the starting point of our budget. Naturally, once we figure out about our income, the next step is figuring out about our expenses. Very similar to how we just did income, we want to use a good sample size. A lot of times whenever I work with people that are building a budget, they'll maybe pull like the last month, last week. Again, I recommend that the larger sample size you can, feasibly look through, the better your budget will be for it. So try to aim for something like 6 months to a year. We want to go through and itemize all of our expenses. So basically we want to categorize them into being fixed expenses. These will be things that for the most part won't change in dollar amount per month or per week, like your monthly rent or your car insurance. We'll label some expenses as variable. These will be things that are going to occur every week or month, but the dollar amount may shift. So things like water and electric bill, or groceries, or putting gas in your car. For variable expenses, we want to go through and get an average of how much they cost over the period of our budget. So again, if you're budgeting for weekly or you want to budget for monthly, figure out how much on average you're spending on gas per month or per week. So these variable expenses, and hopefully if you've got a good sample size of the last 6 months or a year, that should go a long way to giving you some pretty accurate averages. Once we've calculated our fixed and variable expenses, all that should be left are periodic expenses and one-time only expenses. Periodic expenses will be expenses that you shouldn't have very many of them, but they'll be expenses that occur much less often than monthly, but still something that money needs to be set aside for, like possible tax payments, oil changes, new tires. These things will happen more often than never, but much less often than monthly. Anything outside of these three categories should qualify as a one-time expense, and we won't need to budget for them as strictly. With that being said, Before you determine something is truly a one-time expense, really make sure that it is. Car repairs or a medical bill are things that people commonly list as one-time expenses. But if you have an older vehicle or you have health issues, these payments are much more likely to happen again, and we want our budget to reflect that. At the very least, we want to be setting aside some money to bolster some sort of emergency fund for when these events occur. All these should come together to provide a pretty good view of your expenses. Now, we've got the expenses listed. We should have the time frame of each expense down, and we should have, whether or not they're variable, fixed, or periodic, or one time. Now we're going to go through all those expenses and categorize them as either needs or wants. This is typically the most subjective part of budgeting, but it's also one of the most important. So be very honest with yourself. Try to go through and objectively determine how important each of your expenses really are. Because when it comes to determining how much room we have for savings, the first place we're going to look is at how much of the wants we can live without while still maintaining quality of life. How much and where we can cut things to make room for these needs and savings can definitely be tough. No one enjoys depriving themselves of the things they want, but it's how you get your finances under control. It's the first real test of discipline that budgeting is going to throw at you, and it never goes away. I will warn you. Investing is defined as giving up satisfaction today for more satisfaction in the future. So it will get easier to stick with your budget as time goes on, and especially whenever you start seeing the benefits that come from having a good budget that you stick with. But it is always going to be hard to say, hey, I can't buy this thing because it will take me outside of my budget. So go through your expenses, list them as wants and needs. And now, with all of our income, all of our expenses listed, it's time to calculate the grand total. This is subtracting all that income, subtracting all those expenses to come out with a grand total. This should reveal how much more or less we're making than we're spending. This surplus or deficit is going to be the biggest piece of the puzzle for budgeting. And ultimately, it's the number we're trying to control. Calculating this difference isn't just sort of a mathematical exercise. It's going to be the foundation of our financial strategy. It shows us if we have room to save and invest, or if we need to adjust our spending, or if we need to find a new income source. And I know just from building budgets for prior clients, this number can be daunting. I've seen some rough budgets, especially after debt or huge life changes like a divorce or death of a spouse. Some people can have massive deficits, and it can be scary. It can feel very overwhelming, but I want to make it very clear that this is not set in stone. Your budget and your spending is as alive as you are. Knowing where you stand is the first step towards deciding where you're going to go. If you've had debt or you recently went through a life change, by making your budget a priority, you're doing the right thing. And with planning and following your budget, you can absolutely improve your situation. So, to put all these concepts into perspective, I wanted you guys to take a look at sort of an example budget. Due to the limitations of this being a PowerPoint slide, I'm not able to list as many things as I'd probably like, but this is a good starting point. I wanted anyone that is currently creating a budget to have a good idea of the way I'll list these things out. Naturally, you're free to organize it however works best for you. I just recommend having all your income, all your expenses listed, breaking them down into needs and wants, having a frequency attached to how often you get paid, how often you pay these bills, things like that. The more information, the better. And like I said, try to have a large sample size, over the last 6 months to a year. If it's a variable expense, break it down into an average over however long you want your budget to be. If you want it to be a weekly budget, break these things down into an average per week or per month for a monthly budget. And we should have a pretty good starting point for budgeting. Now that we've hopefully created our budget, or at least are on our way toward having one completed, the rest of this webinar is going to focus on ways to better manage your income, expenses, and those goals that we were talking about saving for. A lot of that really starts, and I know I talked about this earlier, but a lot of it really starts with effective cash flow management. It's all about tracking the numbers that your budget is built on. Now that we have a budget, the last thing you want to do is ignore it or let it go out of date. Track your spending habit. Ensure that your income flows match your outflows. Don't let yourself get to the end of the month and realize that $200 went somewhere that you don't know. It's tedious, but make sure you're tracking your spending habits. As I've said, getting to know and taking control of our spending habits is what will help us start to take advantage of the things that the rest of the PowerPoint is going to talk about. Thankfully, there are a lot of tools out there that can help with budgeting. I've known families that kept everything on an Excel spreadsheet or handwritten, but if you want some additional tools there are budgeting apps and some financial platforms that can help. I've seen a few, and they seem to do a pretty good job streamlining the budgeting process. I will warn you, this doesn't really bother me that much, but I know some people, they don't like the idea of this, but I'll warn you, a lot of these budgeting apps I've seen are free. If they aren't making money by showing ads, they're probably making money by selling your budgeting information. So I sort of leave that up to how much that bothers you. For me, I kind of just assume that with Amazon and Google that my spending habits are probably long since out there. But I do want to give that warning. Also, some banks provide information that can help with budgeting. I personally use Chase Bank. They offer breakdowns of my spending habits and what money is going toward. So it's another place to look. I would say that most banks probably have something like that set up. And all of this really comes back to, like I said, getting control of that bottom line of your budget. There's only two ways to free up cash in your budget. You have to either make more money or spend less. And making more money is oftentimes much harder than cutting expenses. So that is the first place I recommend looking. Namely, at cutting discretionary spending. This is going to be combing through all those expenses that we categorized as wants, things like dining out, entertainment, hobbies. These are going to be sort of the first place that you're going to end up sort of cutting to save. Also, negotiating or shopping around on bills, things like cable, car insurance, phone plans. These things have a lot of competitors, and you may be paying more than you need to be. And just as a good example, I swapped from like T-Mobile to Mint, and I was paying like $99 for T-Mobile, and now Mint's like 25 or 30 bucks. So it's like 65 bucks more per month. I'll admit, the trade-off is now I am inundated with those Mint mobile apps, or not apps, but the advertising. And I think Ryan Reynolds is a great actor. I hate those Mint mobile commercials. I am so sick of seeing them. But my point is that it would surprise you how just shopping around on some of these things that seem like fixed expenses, car insurance, phone plans, you can end up saving quite a bit of money. Also, shopping more wisely, taking advantage of coupons and discounts. The idea is to, like I said earlier, cut unnecessary costs while still keeping quality of life. By identifying and eliminating unnecessary costs, we'll be able to free up funds for saving and important expenses. It may not seem like it, but small things will add up significantly over time, especially when we start talking about investing for long-term goals. Once your money starts compounding, it would surprise you. In my example, how I said I probably saved like $65 a month just changing who my phone plan is through. $65 per month when it starts compounding and you have a long-term goal that's maybe 10 years down the line, that can end up being a lot more money than most people would think it will be. But before I get too much into talking about investing, I wanted to discuss building out an emergency fund. The vast majority of people don't have one, and it is a huge source of stress. I believe that outside of The reason I sort of feel like it's so rare to have an emergency fund is that outside of money being tight for a lot of people, I think it can feel very unattractive to set money aside for reasons that aren't completely clear or for emergencies that may not happen. But whether we like it or not, trust me, emergencies are almost an inevitability, and preparation is hands down our best defense against it. To some degree, having insurance also plays a role in this as well. Getting into an expensive medical situation can be incredibly stressful and financially taxing, especially if you don't have health insurance coverage. I know that building an emergency plan and affording insurance can be tough on people. Depending on your financial situation, that is completely understandable. But in the long run, not having an emergency fund is going to be more expensive than saving up for one starting now. At the very least, even if you feel your budget is too tight, it's important that you look into these things and make note that they exist and are a priority. Down the line, your situation will change. The next time you get a raise or you move jobs and make more money or you get a bonus, really consider putting that money toward a future emergency. Some specific recommendations on emergency funds. Aim for 3 to 6 months of living expenses. Put this money in a safe and liquid place, somewhere that you can draw on that money quickly if you need to. And again, I know that 3 to 6 months can seem daunting. Most Americans live paycheck to paycheck. Getting away from that is what getting your financial health under control really means. Even if it's just building and following a budget that lets you save $5 a day. So while in the long term, living without an emergency fund is risky, I want to make it clear that it's okay to slowly begin building one up. Start now by aiming to put something like $20 a week into an emergency fund. Over time, this will build up, and when a car problem or medical issue arises, this will go a long way towards helping. Naturally, $20 a month, it might take you a good amount of time to get to that 3 to 6 month mark, but there will be a lot of emergencies that come up that won't take 3 to 6 months. 3 to 6 months is usually the worst case scenario. A lot of emergencies will, like I said, be things like car issues. Things like you all of a sudden need a new phone and you are going to have trouble stretching your budget to get one. Those things are much more common emergencies that can be solved by a relatively lean emergency fund. But still, the overall goal of eventually get up to that point where you've got 3 to 6 months, where if you lose your job or have a medical emergency that takes you out of work for a while, that you'll still be okay. I also recommend putting this money somewhere that it will grow. Otherwise, inflation will erode your purchasing power. The last thing you want to do is have an emergency and realize that you kept your entire emergency fund underneath your mattress. And now that money is not as valuable as it was 10 years ago whenever you first started storing this stuff. So things like high yield savings accounts, money market funds, other very liquid investment vehicles that still provide access to the money quickly enough that you can use it when you need it, but will still grow enough to compete with or beat out inflation. So I want this webinar to stand the test of time, but I will say that as of filming, by filming, I mean as of right now during the webinar, that I think I saw high yield savings accounts that were they're between 4 and 5%. That should pretty handily beat out average inflation and still lead to you growing some beyond that. So I would definitely take a look at high yield savings accounts for things like your emergency fund. Now, on top of how I mentioned a lot of Americans are living paycheck to paycheck, a lot also live with debt, and it can be a very heavy burden. But it is something that you can definitely overcome. I've had a lot of clients that have debt, and while I've seen some pretty rough debt situations, I've never had anyone come to me and I just go like, wow, this person is never going to get out from under this. For the most part, that really doesn't happen. And student loans and tax bills aside, that is sort of what things like bankruptcy is for. Not that I'm saying you should jump the gun and go to that route. My point being is that if you have debt, you do have options. And I've not encountered a situation where I truly felt like somebody was never going to get out from under this pile of debt. But the first step is fully understanding your debt. Like I said, I've had clients that have debt, and it would amaze you how often I ask them, what are the minimum payments? Are there maximum payments? What's the time frame? What's the interest rate? And they don't have an answer to these questions. You should understand your loans like the back of your hand. Get to know what the minimum payments are. Get to know if there's any maximum payments. Understand what the interest rates are and what the time frame you're looking at to pay them off is. The more you know about your debt, the better. This allows us to make a plan on how we're going to tackle it. Start by focusing on the debt with the highest interest rate. For a lot of people, this is going to be credit card debt. For example, if you have multiple lines of debt with the highest interest rate, start by focusing on the one with the highest interest rate. For a lot of people, this is credit card debt. For example, if you have multiple lines of debt and only a certain amount of money that you want to put towards it all, pay the minimum on the lower interest rate debt and pay as much as you can on the highest interest rate debt. Just for a pure example, say you have maybe 3 credit cards and you want to put $300 towards that, all those lines of credit per month. My recommendation would be you figure out which of those credit cards has the highest interest rate, put the minimum payment that you can on the other 2 credit cards, and then put the rest of that $300 towards the credit card with the highest payment. This should allow you to start paying off the highest interest rate debt faster than the other 2, and you'll slowly knock them out one by one. Once you've fully paid off that highest interest rate one, then you move on to the second highest interest rate line of debt, and so forth until you pay it all off. This should lead to your debt compounding the least amount that it can. So another option is also you can look at loan consolidation. Basically, you pay off your current loans with a new loan that should hopefully be at a lower rate. So loan consolidation would be like those 3 credit card example I just mentioned. You take out another loan that gives you enough money to afford to fully pay off all 3 of those credit cards. And now you're just paying on that one new loan that, again, hopefully has a lower interest rate than your credit cards did. So it's something that you really have to shop around for, before you make that decision. But the point is, once you have some sort of payment plan made out, the next step is to stop adding to debt. Build your budget around not having to use your credit card and not having to take loans. I see it very often that people do a good job of knocking out debt, and then they, don't build an emergency fund. So as soon as an emergency comes up, they put that right on their credit card. Or, they get a loan consolidation. They use that to pay off their credit cards. So now they're just paying for that new loan that they took out. But since their credit cards are opened up, they go right back to those old spending habits. And now instead of consolidating from 3 lines of debt to 1, they've now got 4 lines of debt because they've not done a good job following their budget or sticking with, disciplined financial decisions. Credit cards can be useful in emergencies or to help build credit. But beyond those rare and very strategic situations, most people should really not be using their credit cards. Now that we have a budget in place, we've worked towards having an emergency fund, paying off debt, we can finally get into investing. It's exciting. This is where wealth accumulation starts. As we talked about earlier, once you have financial goals laid out and you've created a budget that allows you to save, the next step is going to be investing that money so it can grow and allow you to afford goals that you otherwise may not be able to if you were just dependent on your current income. This is especially true for longer-term financial goals like retirement. Investing, I'll warn you, it's in and of itself, it can be a little complicated, and specific recommendations will definitely differ person to person. So for the time, just for time's sake, we're mostly going to touch on preparing yourself for retirement. But if you want to dig deeper into general investing, I've done multiple other webinars on how to get into investing, and you can find all those recordings on the Lively Financial YouTube channel. I also will probably end up redoing quite a few of those old webinars just because, I think that all of this stuff is getting a lot more attention than I was expecting. So I think a lot of people would love another chance to see some of these webinars in action. So, but if you want to get more into just dipping your toe in investing, you can check out the YouTube channel. In the short, though, of just for this webinar, the first place I'd recommend looking to start investing is by opening a retirement account, such as a traditional IRA or Roth IRA. And I would also recommend opening up a standard investment account. These aren't tax advantaged accounts, but they will allow you to put money in and you'll be able to invest from just a standard investment account. These should, all these accounts should be pretty easy to open through your bank, and it will allow you to be able to move money into these accounts and then place them into investments. So for new investors, I would highly recommend looking into index funds. They're very cost effective and a good way to get a diversified portfolio. So if you're really hungering for some investment recommendations, and you're newer to it, I would highly recommend checking out index funds. So specifically when it comes to retirement planning, and those accounts I just recommended, a Roth IRA, a traditional IRA, a lot of people I found by this point in time usually know a good amount about these accounts, but just in case, a Roth IRA is a tax advantaged retirement account in that the money in the account, you put it in today after tax dollars. So you put money in there that you've already paid taxes on, and that money will then grow tax-free and you can take it out in retirement without taxes. A traditional IRA is sort of the opposite of that. The money you put into a traditional IRA can lower your current taxes, but will get taxed when you take the money out in retirement. Which one is better for you depends on your income, your tax situation, and the time you have until retirement. But I highly recommend everyone understand these accounts and consider opening at least one of them. As of this year, for an individual, you're able to max out your retirement account with $6,500. And that goes between the two. So if you have both of them, it's still $6,500 total. So this can be a lot of money depending on your situation. And while it is great to do so, you don't have to max out your retirement account. Put aside as much as you can afford and understand that you will not be touching this money until retirement. It might seem far off, but it's never too early to plan for it. And trust me, the sooner you start planning for retirement, the better off you will be. You will thank your current self later down the line. Also, get to know your employer-sponsored plans. If you have access to a 401k or 403b, aim to put in at least enough of your paycheck to max the match your company's offering. This is about the closest you'll get to free money. So if you're maxing the match on your 401k, you have a retirement account set up that you're investing into, try to max out your retirement account with $6,500. But again, just put in as much as you can. If you do all this, you should have a pretty good starting point to begin saving for retirement. The next step is either the most exciting or the most nerve-wracking, and this is monitoring your progress. Now that we've got those accounts open, we've got a budget made, now we're going to watch our investments grow or watch the market downturns or watch ourselves deviate from our budget more than we probably should. As I said, budgets, your financial plans, they're all as alive as you are. Don't ignore them or let them fall out of date. I aim to have a minimum of 12 interactions with my clients each year, and every time we will discuss their financial situation, how budgeting has been, and if they are accomplishing their financial goals. It isn't always easy. Staying on track will require that you're disciplined and motivated, but the best thing I've seen help with that is either have someone hold you accountable. For a lot of my clients, that's a big part of my job, is holding them accountable, to sticking with their budget, to accomplishing their financial goals. Also, let yourself get excited about growing closer to your goals. Don't let inevitable life changes discourage you from keeping a plan. If you're diligent, you're going to be monitoring your progress anyway, so make it a positive experience. Get excited about balancing the budget, because that's going to let you watch your retirement account grow or that's going to watch your investment account grow, that's getting you closer to a down payment on a car or a house. These things are genuinely exciting, and your budgeting experience will be a lot better if you let yourself get excited. Also, once you've spent some time monitoring your finances and following a budget, you'll be able to start automating that process. This is huge and sometimes often overlooked. With a well-made budget, we should have a pretty good idea of things when it comes to income and expenses. And like I said, once you follow a budget for 3 to 6 months, you're going to see your spending habits. And this is going to open up the door to doing things like creating payment schedules or setting your bank account to move a certain percentage of your pay each week or each month into your investment account. Setting up automation can go a long way towards making the whole budgeting process much easier and achievable to follow, especially when it comes to the long term. This goes back to what I was saying about some apps and things. Look into automation tools that your bank offers. At the bare minimum, I recommend to add a reminder to your calendar to balance your budget, or schedule a day each month that you and your partner sit down and talk about finances. So basically, we ideally made the budget over a good time frame using the last 6 or 12 months. Once you follow that budget for 3 to 6 months, you should have a pretty good idea of your spending habits. That should allow you to go into your bank account, set up some automations that make your budgeting process a little bit more hands-off. And that can help a lot of people. So it has been a lot, but we've really only scratched the surface of budgeting and starting with financial planning. It definitely doesn't stop here. Take an interest in your financial situation, learn and understand how investing and the markets work. Get an advisor that will help teach you what you need to know to achieve your financial goals. I am always happy to give article and book recommendations. Finance and wealth management is my life, and I am always researching these things or writing articles on them. So if you ever want some recommendations, I'm happy to give some. Don't hesitate to reach out, and never stop learning. Your financial health is going to be, I'd say, one of the 3 most important things in your life. So take an interest in it for sure. All right, before we get into the Q&A, I want to recap. You should have a pretty good understanding of how to create a budget, some things that should be included, and hopefully you have some ideas of good financial goals to be aiming for. Beyond just budgeting, we talked about saving and investing, opening retirement accounts, and automating your budgeting process. I know I threw a lot at you guys. Hopefully it wasn't too much. The key takeaway I want you to get from this is really motivational. It's that budgeting is the first step towards getting control of your finances. And no matter what your situation is, you can make it better. It will take discipline, and it may not be easy and probably will be slow at first, but it's absolutely worth doing. And you don't have to do it alone. I'm happy to help. Really, just let me know if there's anything you need at all. I've built a lot of budgets for clients. I'm always happy to help. All right, it is time for my favorite part, the Q&A. So I've got some questions already from people, but if you want to go ahead and add some new ones, at the bottom of your screen, there should be a place to submit questions. It may also be an arrow at the bottom right-hand corner of your screen. While people type them out, I'd like to thank you guys again for coming. I'm Chad Lively. I'm the lead financial planner for Lively Financial. I am happy to help any one of you on this call. So feel free, give me a call, reach out via email. You can also go to our website, livelyfinancial.net, to book a time with me. We also have a newsletter, a YouTube channel where these webinars get saved to, and I publish many articles on our website. So like I said, feel free. If you need anything, reach out to me. If you have any questions, feel free to ask them now, or you might be able to find the information already on our website or YouTube channel. All right, it looks like we have some questions coming in. Let me see if I've got the questions all set up. All right. What are the first steps someone should take when creating a budget? So I'm guessing you may have joined the webinar a little late. The first step is to gather all your financial information, things like income sources and expenses. Next, you want to organize them, like when you get paid and how often. You want to categorize your expenses into fixed, variable, and periodic. Then you'll calculate your total income and expenses. This should determine whether or not you have a surplus or a deficit. And that should sort of be the bottom line of your budget. That's really the number you're trying to control. So how do I determine the right budgeting method for my unique financial situation? The right budgeting method depends on your preferences and goals. Like I said, it's really whatever budgeting method will allow you to accomplish your goals and that you can stick with. Zero-based budgeting is stricter. As I was saying, it sort of assigns every dollar a purpose, but it can be better if you're well organized and like having a firm plan. Alternatively, 50-30-20, it simplifies budgeting and makes it more flexible. If you're really not sure, I recommend using a combination of the two or experimenting with different methods to find what works best for you. Like I said, the best budgeting method is the one you can stick with. But pretty much inevitably, no matter what budgeting method you use or how you organize it, you're going to have to track your income and expenses. That's going to pretty much be unavoidable. So as you're experimenting, get used to tracking your income and your cash outflows. Can you provide some tips on effectively tracking expenses without it feeling overwhelming? I get that. Tracking your expenses can be a lot of work. My best recommendation is to look into expense tracking tools. Like I said, mobile apps, dedicated software. I also believe that setting aside a specific time each week or month to update your expenses makes it much more likely to happen. Once you do it enough, you'll start to gain insight into your spending patterns, and that will make tracking things easier. Over time, it'll probably surprise you. Tracking expenses will become a routine habit. And while it might seem like a chore now, it definitely gets easier. And especially as you start working towards goals, it gets a lot more exciting. What strategies can I use to reduce unnecessary expenses and free up more money for savings? So reducing expenses is going to begin with identifying areas where you can cut back, like how we organized our expenses into needs and wants. That's where you want to start. Discretionary spending, like dining out or subscription services, get to know your bills and if you can shop around for lower rates. Also, just small things like using coupons and seeking discounts. A lot of people don't think it matters much, but even a small amount of savings each week or each month can accumulate pretty significantly over time once you start letting them compound. How much should I ideally aim to have in my emergency fund? So, as I was saying, a good rule of thumb is to save 3 to 6 months worth of living expenses. But really, it all comes down to your individual circumstances. Things like job stability, financial responsibilities. 3 to 6 months may not be the right amount for your specific situation. After you sort of have an idea of how much money you need, you want to start putting the money in there toward your emergency fund in your budget. That should become a focus. You should have a line item in your budget of how much money you're aiming to put inside of your emergency fund. This way you're making regular contributions and eventually you'll reach that target amount. This is getting a little bit into the weeds, but I also, again, recommend you put that emergency fund somewhere that you can access it quickly and that it also grows over time. Like I said earlier, I threw out high yield savings accounts. They're a good place to start looking. Something like a money market fund is also a good place to look. Could you share some insights into managing and prioritizing different types of debt, especially high interest debt like credit card balances? Yes. So it is kind of like the example that I was talking about earlier. Uh, Debt is usually one of the biggest things getting in the way of budgeting. It would surprise you if you got a couple $100 per month going towards budgeting, or I mean, going towards debt. Once you eliminate that debt and you can start putting that towards saving, it will absolutely compound far more than you're probably expecting over the long run. You want to, again, prioritize high interest rate debt. This will typically be things like credit cards. Focus on paying off the highest interest rate debt first while making minimum payments on the others. Or you can also consider debt consolidation or balance transfers to lower interest rates. Mostly you just want to, like I said, understand your debt, and then you're able to create a structured debt repayment plan and stick to it. How can I automate my financial tasks? And what precautions should I take to ensure everything runs smoothly? So that is true. Especially whenever you start looking into automation, make sure that you're not getting yourself into hot water in terms of, having checks bounce or, going into the negative in your accounts. These sorts of things you want to avoid. So it can be a little difficult to sort of dip your toe into automating your finances, but it will really help most people. It's going to offer consistency and convenience. It will ensure that your bills are paid on time and that your saving contributions are regularly getting made, so you're not missing payments towards those things. And really, like I said, missing payments on stuff like debt, those are financial landmines that you want to avoid, and automation can help with that. To suggest that it runs smoothly, I first recommend that you start by living on a budget for a while. Like I said, 3 to 6 months of living on a budget, doing things manually before automating them. Once you've spent some time monitoring your accounts and budgeting regularly, you're going to see your spending habits. That's going to let you set up alerts for unusual activity. You can make sure to maintain a sufficient balance to cover automated transactions. Setting these things up all require knowing your financial pattern. That's why I recommend, once you made that budget, doing it manually, living off of that budget for 3 to 6 months. That should enable you to automate these things pretty accurately. When it comes to retirement planning, how can I prep better? So some common retirement, I talked a lot about, obviously opening up a traditional IRA or a Roth IRA, putting money into your 401k. I would say on the other end of that, some common retirement planning mistakes include things like mainly not starting early enough. I want to make clear that it's never too late to start planning for retirement, but the sooner you start, definitely the better. Not contributing enough to retirement accounts. A lot of people have more money to invest than they probably realize, and even a relatively small amount can go a long way once it starts compounding for something as long-term as retirement. You have a little bit of money over 30 years will grow to be quite a bit more money than you're probably expecting. And then actually getting into the investing side, a lot of people are not diversifying their investments well enough. They have, a lot of their money in, one holding, or a lot of their money in just equities, for example, and they're not diversified between equities and bonds and other asset classes. So I'd say a lot of people usually don't diversify enough. Again, I recommend to save for retirement, start as early as possible, max out the contributions on your retirement account, get the most of your employer's match in your 401k and your 403b, and diversify your investment portfolios. So I know I have mentioned it a couple of times, but if you're just dipping your toe in investing, I'd look at something like index funds. They're typically pretty low expense ratio, and they do a good job of easily allowing you to buy diversification. Well, funny enough, this next question, what's your advice for someone who wants to start investing but doesn't know where to begin? Are there any beginner-friendly investment options you'd recommend? So funny you should ask. For beginners, I would focus on buying into funds. Again, index funds, ETFs, these things, it's an easy way to get diversification. It doesn't require stock picking. And depending on the fund you choose, it can be pretty inexpensive. Things like diversified mutual funds, exchange traded funds, or again, I especially recommend index funds to new investors. Shop around, Find one that aligns with your risk tolerance. Ideally, these investment options provide instant diversification and are less volatile than individual stocks. Also, if this money is being put away for retirement, open tax-advantaged retirement accounts, such as traditional IRAs, Roth IRAs. Use your 401k. Buy these funds in those accounts for the tax benefits. And I would say that if you're a new investor, that's probably the first place I would recommend looking. Let me see. So that looks like that's probably all of the questions I see so far. I know that we've got a couple of minutes, so I'll do sort of a last call, and then I'll give back, about, I guess, 2 or 3 minutes. So it is just about lunchtime. All right, does anyone have any sort of final questions? All right. It doesn't look like it. So again, I'm Chad Lively. I'm the lead financial planner for Lively Financial. Feel free to reach out, give me a call, shoot me an email. My phone number's there. My email address is chad.lively@livelyfinancial.net. Or you can go to our website, look at our articles, book a time with me. You can check out our YouTube channel, Lively Financial on YouTube. And that's where this webinar is going to get saved to, as well as our past recordings. So again, if you have any questions, feel free to reach out to me after the webinar. And I hope that everyone has a great day.